Greetings again, traders. I want to quickly show you the difference between a shift in market structure or a change of character or a market structure shift and a break of structure. Last time we did the bullish scenario, bullish shift in market structure or bullish change of character, bullish structural market shift and bullish break of structure. Today I'm going to show you the bearish scenario, and in our last video we did a bit of market structure which we are going to continue here. In case you did not watch, I recommend that you watch that video again over and over so that you can understand what we are going to do here. Now we say there are three forms of market structure. We have a market structure that is bullish when the market is forming higher lows and higher highs, a market structure that is bearish when the market is forming lower highs and lower lows, and we have a ranging market where the market is neither forming higher highs nor lower lows, like it is simply just consolidating. We are going to look at the bullish scenario. Okay, now let us say we are looking at a bullish market. A bullish market occurs when we see the bulls or the buyers in control of the market. They form higher lows. This is a low, and the next low that is going to be formed should be higher than this old low, and the next high that is going to be formed should be higher than this high. This is a high. Okay, so it is going to form a higher high, meaning a high that is higher than the previous high, and it's going to form a higher low. This is a low, but it is higher than this previous low. Okay, so it is a higher low. I hope you understand this. This is another high, but this high is higher than this previous high, so it becomes a higher high. It forms another higher high, and then another higher low, a low that is higher than the previous low, that is a higher low. So it's going to continue. Okay, showing that it is an uptrend or a bullish market. This simply means that the buyers are in control of the market, or the algorithm, since we are talking smart money, is in a buy program, or the algorithm is reaching out for buy side liquidity, offering buy side price delivery. I hope this is clear. You have to listen to that again. When the algorithm is offering buy side delivery, it is seeking buy side liquidity, and when the algorithm is offering sell side delivery, it is seeking sell side liquidity. Okay, you understand that very well. So it forms another higher high and another higher low and another higher high. Now if the algorithm, okay, if IPTA takes out this last higher low that was formed, we consider it a bearish shift in market structure. Okay, it means the structure of the market has shifted from bullish to bearish. That is the meaning of shift in market structure. It means the character of the market has shifted from being bullish to being bearish. That is a signature that the smart money is going to show you to indicate that it is about to change direction. How do you know that? This last higher low has to be violated. Okay, and it has to be done so after running these tops here, because there's buy side liquidity resting above here. When this buy side liquidity is taken away and then IPTA aggressively drops, trading below the last higher low that was formed, okay, we say the market has shifted structure, or we say the market has changed its character. Now how do you trade this? You are going to define this low, this new low that has been formed, and this high that was formed. That is your dealing range. Okay, that's your dealing range. So as a smart money concept trader, you want to wait for price to trade from this low back into this high before you can take your entry, because this low that has been formed is considered a discount, and this high that has been formed is considered premium. And when you want to sell, you only have to sell at premium, and you only want to buy at discount. So you are going to measure this low and this high, and that is going to be a dealing range. A dealing range is formed when IPTA takes out liquidity both sides. Liquidity has been taken below this low, that is sell side liquidity, and liquidity has been taken above this high, that is buy side liquidity. So this range is called a dealing range because it has taken liquidity above this high and below this low. So you will want to wait for IPTA to trade back into this range before you can take your entry. Now this is what happens. Anytime IPTA, which is the interbank price delivery algorithm, according to the founder of the smart money concept, that is the primary driver of the market. Okay, anytime IPTA takes out an old high and displaces aggressively, it means it is in a rush to deliver sell side price delivery. Okay, now there's always a possibility that it is going to leave imbalances inside this range. Okay, imbalances in the form of fair value gaps, imbalances in the form of liquidity void, imbalances in the form of volume imbalances. Okay, now you can also look for other blocks over here, breaker blocks, mitigation blocks over here. Okay, when price trade back into premium into any of those key PD arrays, that is when you should look to take your entries. Another form is you can simply measure this low and this high using your Fibonacci tool, and you want to see price trade above the midpoint of this range. The midpoint of this range, if you use your Fibonacci tool, is going to be called the equilibrium. Okay, above the equilibrium is going to be premium, and below that equilibrium is going to be what? Discount. So you always want to sell above that equilibrium, which is at premium. So when price moves from this discount here above the equilibrium level, it means it has gone into premium. Premium simply means it is very expensive. So you are going to look for PD arrays inside this premium level, fair value gaps, liquidity voids, breakout blocks, mitigation blocks, order blocks, bearish order blocks inside here, and that is what you are going to sell into. Okay, I hope this is clear. So when this displacement happens aggressively, look for imbalances within here, wait for price to trade back into those imbalances, and you sell them. Now, how do you measure that? You are going to use your Fibonacci tool, which I taught in the other mentorship, and you are going to look for entries using the 62% FIB level, 70.5 FIB level, and 79% FIB level. You have seen me execute trades on that, and it's actually very successful. So you wait for price to come here and you take your entry. Now you can wait for a small shift in market structure again over here, and that is when you will take your sell. Now when this low get completely violated, that becomes a bearish break in market structure. Remember, when this low was violated, we said it is a shift in market structure or a change of character. When the first low gets taken by another low, it's a change of character. When this new low that is formed gets taken away, it becomes a break in market structure. This means that this structure has completely been broken. Now we are forming a new structure, which is a bearish structure, and now you will see the market continue downward. Anything that happens below here is a break in market structure. If this low gets taken again, it is a bearish break in market structure. Okay, if this other low gets taken again, that is still a bearish break in market structure. I hope it is understood. Now what happens if IPTA continues to do that, and at one point again, this is a break in market structure? Let us assume that at one point again, this last lower high gets taken again. What has occurred? This one again becomes a bullish shift in market structure, which means that IPTA is changing the market direction again from being bearish to being bullish, and that is how the market continues, and you may probably see another uptrend continue. Okay, so if you understand something like this, it is very easy to navigate the market. I hope it is clear. So what you simply do is whenever this last higher low gets taken, you are going to come here. This is how you annotate your diagram as a smart money concept trader. So you are going to label this a shift in market structure. Okay, SMS, shift in market structure. Always make sure you position it to the bottom and center. Okay, that's it. That's a shift in market structure. It has to be straight. Okay, smart money concept traders, your annotations always have to be straight. That's a shift in market structure, a bearish shift in market structure. Okay, now when this other low, this new low gets taken out, this becomes a break in market structure. You are going to label it BOS. Okay, break of structure, and it has to be bottom and centered. I hope this is clear. So anything that happens below here is a break of structure. This is another break of structure here. You label it break of structure. This is how you annotate your chart. This is a break of structure, BOS. It should be centered and at the bottom. So anything that happens below here is a break of structure. Then if this last lower high, remember this is a downtrend, it forms lower highs and lower lows. Okay, now if this lower high again gets violated, what has occurred here? This is a bullish shift in market structure. Okay, and this one has to be top and centered like this. Okay, I hope this is clear. Now if it continues as an uptrend, this becomes what? A bullish break of structure. Okay, I hope you get this. It is very easy to annotate it. You said you were finding it difficult, but if you just follow this video, you understand it better. So anything that happens above here, if this high again gets violated, it means you are in an uptrend, right? So this becomes another break of structure. It can continue like that until the last higher low gets violated again. Only then will it become a bearish shift in market structure. You see, it can continue like this. Okay, this is how the market simply moves. This is how it simply moves. I hope it is understood. So I've taught you how to use the Fibonacci tool, and I've taught you how you can measure these ranges. I hope you go back again and you watch that video. So when the market displaces itself like this, what you simply have to do is you take your Fib tool, you measure this low and this high over here. Right now, anything above this 50%, this 50% you see here, or let me use my crosshair, anything above this 50% is equilibrium. Oh, give me 1 minute. Oh, just give me 1 minute. Good. Anything above here, this 50% level, is equilibrium. You see this red zone over here? This is equilibrium. And anything below this 50% here is discount. So if you are a seller, you always want to sell into premium. Look for any imbalance around here, fair value gap, liquidity void, order block, and you sell into those PD arrays, right? If you do not find them, you use the Fibonacci tool. I've taught you that. Use the 62%, 70.5%, and 79% Fib level. Use those levels to sell into this premium. Don't sell at discount, sell at premium. Okay, now sometimes 50% can also act as a premium PD array when the market is about to be bearish. I hope you will listen to that again. I know it's confusing. Yeah, let me use this one. Good. Sometimes you can also use 50%, which is the equilibrium level, as a level to sell into. You can also sell at this 50%. Sometimes IPTA will just take price to the midpoint of this range, which is 50% or equilibrium, and it will sell off. Sometimes it will take price back into this range. Maybe it is looking to fill a fair value gap or a liquidity void, or to trade into an order block, a bearish order block. You can simply just trade into it and then it sells off. I hope this is clear. That's how you use optimal trade entry, and then you can target this low as your area of take profit, because sell side liquidity is going to be resting below here, and IPTA will want to take price below that level to attack those sell side liquidity since it is bearish. Now this other level also, if this last lower high gets taken away, what you simply have to do again is you are going to take your Fibonacci tool. That's how you measure ranges. You will take your Fibonacci tool and you measure the highest high that was formed at that level, like this highest high, and the lower low that was formed, the lowest low that was formed. Okay, let me put it this way, or better still, let me reverse it. Just give me, let me put it this way, no problem, it's the same. So this is premium and this is discount. Good. This is another range that has been formed, so you will have to wait for, when it displaces higher, you want to wait for IPTA to take price back into discount. Below this 50% level, which is the equilibrium level, is discount, and above this 50% is premium. You don't want to be buying into premium. You want to wait for price to drop back into discount or 50%, okay, and then you are buying at discount, because that is a level where price is cheap. Above equilibrium, which is premium, price is expensive. Below equilibrium, which is discount, price is cheap. So look for any fair value gap, liquidity void, order block inside this discount level, and then you buy into that. You can use the OTE trade entry levels 62, 70.5 and 79%, and then you take your entries here. You can target your profit right over here because buy side liquidity is resting above here, and IPTA would want to reach for those buy stops, okay, to take out people who sold here and put their stop losses over here. IPTA will want to attack them. I hope this is understood. It may be a little bit complex, but I hope that you'll be able to watch it over and over, and trust me, it is not very difficult. Let me see if I can find an example on the chart and then I show you. This video is already long, but please just bear with me. It's going to help you. Now look at this. This is an uptrend, right? You bear with me that this is an uptrend. This entire move here is an uptrend. This is not different from what I've taught you. This is an uptrend here. Now this is the last higher low. You see, we are forming higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, and then higher lows. Now when this last higher low gets violated here by this drop, what has occurred here? This is a bearish shift in market structure, okay? This is a bearish shift in market structure. That's GBP USD. At the time of recording this video, it is the 30th of August 2024. Yes, so this is GBP USD live market. So GBP USD has simply shifted structure by taking out the last higher low that was taken. Now look at what happened. Immediately that low was taken, IPTA did not continue to trade. IPTA had to trade back into this range, okay? IPTA had to trade back into this range like what I just explained below here. So what you have to do is you have to define, this is a range low and this is another range high. Why is it a dealing range? Because this low took out this liquidity and this high took out this liquidity above this relative equal low highs or old highs. So this guy here becomes a new range. So you have to measure this range from this low to this high, okay? This is what I've taught you. Anything that is below this low is discount, and anything that is above that high or 50% is premium. Look at something. This is 50% of this dealing range, right, which is equilibrium, and this is a low which is a discount, and this is a high. Anything inside here is at premium. Look at how IPTA took price into this premium. I also told you that you can use 50% to take entry, because sometimes when the market is too bearish, IPTA can use 50% as a means to short into. Now, what did IPTA trade into? If you look at this wick here is a rejection block, okay? That is a rejection block. I've taught you rejection blocks. So this guy here is a rejection block. IPTA traded into the midpoint of that rejection block, okay? That wick there is considered a rejection block, and IPTA would always use wicks or tails as gaps, okay? And we see that the midpoint of a gap is called a consequence encroachment, CE. So you see how IPTA traded here. Forget about these wicks. Look at this candle body staying below the midpoint of this wick. So IPTA will look for any institutional reference point in premium and trade into that before selling off. I hope you understand what I'm saying. See, he traded here and then he sold off. Now if you do not look at that wick, let's say you do not look at that rejection block, you can decide to toggle on your optimum trade entry levels. Let's start with 62%. You can start with 62%. If IPTA violates it, then you go to 70%. See, look at that zone, 62% fib level. Look at how IPTA traded into that zone and then it sold off. I hope this is clear. Now you can also go to the smaller time frame. If you look here very well also, you realize that this price move here is an uptrend, okay? This is an uptrend here, this small move over here. Now what happened? The moment price broke below this last higher low that was formed, if you agree with me, you can bear with me that this is an uptrend because it's forming higher high, higher low, higher high, higher low, higher high, higher low, okay? And it continues. When this higher low gets taken out, this is a shift in market structure. So IPTA displaces price aggressively, okay? So this low now that has been formed and this high that has been formed is another range on a lower time frame. That's how you look at price. Now let me show you a second example how you could simply trade this, okay? So you could simply, two scenarios. If you do not see this bigger move, no problem. Let's say you took this small one. give me time. This video is already long, but I'm sorry, I have to explain something. Let us say you measured this low, that range, this dealing range, okay? Let's say you measure this range, this low and this high. This was your range. Now price traded aggressively lower, okay? Now you are going to take that range and you wait for price to trade back above this equilibrium level. Midpoint is equilibrium. Above midpoint or above equilibrium is premium, below equilibrium is discount. Now see how IPTA took price back into this equilibrium, traded into 62% fib level and sold off again. I hope it is clear. I notice it's going to be complex for now, but with time you are going to get it. So when IPTA takes out this low, this is your shift in market structure on a 15 minutes. So measure this range, okay, and then you trade into that. You can also do this. This is another range here. This displacement here, this is another range here, okay? This displacement from this highest high to this low, okay? This is another range here, this one, you see. Now you are going to wait for IPTA. This is a shift in market structure, okay? A shift in market structure. You wait for IPTA to trade back into this range and then you take your trade into that, okay? This is another one here. Let me show you this one, and this will be the last example. Let's do this one. This is the one that I shared in the group today, if you can remember. This range, this low here, okay, and this high here. Good. This one, good. So when this low gets taken out, it's a shift in market structure, okay? It means we are bearish. When this other low, when IPTA trades back and trades below this other low, this is a break of structure. This one here becomes a break of structure. So when I saw this break of structure, what did I do? I took this range high and this range low. That's a displacement. I waited for IPTA to trade back into premium, okay? Trade back into premium. Look for any PD array into this premium and I will sell into that. And then I saw this other block here, which is a mitigation block, this mitigation block here, and then I sold into this mitigation block, okay? Bearish mitigation block. That's an institutional reference point. Another confluence is that I took my Fibonacci tool and then I measured 79% fib level, and then if you notice how IPTA hit this 79% fib level, it was so good, okay? IPTA hits that beautifully. See, this is not random. You see, look at how IPTA hit this level, which is an optimal trade entry level, and then I sold into this level, okay? I sold into this level. So I am anticipating that IPTA will target this CSI liquidity below here. So this video is already long, but I'm sure you have been able to understand the difference between a bearish shift in market structure and a bearish break of structure, a bullish shift in market structure and a bullish break of structure. Thank you so much for listening, and if you have any questions, make sure you ask and I will explain again. Thank you so very much and goodbye.